Well, g'day there, traders and friends, market enthusiasts right around the world. You are here with James once again on behalf of Pivot Point Trading as I sit down and bring you this Monday afternoon market recap. I've got a few major points, maybe 3 or 4 topics, which I want to discuss with you about over the next maybe 10 to 15 minutes or so. Some very important continuation types of signals which we've seen set up, especially through Monday's trading session. And what I'll do also, I'll zoom out onto the monthly time frame and bring up some major moving average crosses which have just occurred as at the close of the month, trading obviously February 2016. Before I move into the analysis, first of all, I just wanted to say if you appreciate these videos or if you find them interesting or if you're learning a lot through the analysis which I go through, I'd appreciate it if you give this video a thumbs up, just so I know. I mean, I'm not sure whether you want me to continue with these analysis videos. Obviously, the last video I posted caused a little bit of a stir, and it wasn't my intention to upset anyone whatsoever, but I mean, it sort of blew up a little bit in terms of what I generally get in comments walking through these analysis videos. So just give it a thumbs up if you appreciate it, and if you want me to continue with these midweek market updates or throughout the trading week when we get these really major signals, which of course I think you should be alerted about, of course, for the trained eye and for the professional trader. So what I'll do for you right now anyway is just move into the chart, and what I'll do first of all, I'll start with the daily chart on the Dow Jones Industrial Average. Today we've seen the formation once again of a very powerful reversal signal. This reversal signal right here is what we call an evening star reversal pattern. It's a 3-day pattern, and it sets up with a long day Morobozu, or very close to that, some form of a spinning top. This is almost a shooting star, which took place on Friday last week, where we started to see a little bit of a reversal show up. And then, of course, today we started the trading session somewhat strong, but towards, or really from about mid-morning all the way through to the close, we closed at the lows, and we've established once again that morning star or that evening star reversal candlestick pattern, very similar to the pattern which showed up just over here. These patterns repeat themselves. It's just the sentiment of the collective trading in the market, and it is a very strong sell signal. It doesn't come as a surprise that it is showing up at the bottom of this red box, which I've had highlighted on my screen, just between about 16.6 all the way up to about 17,250. So going by this analysis as at the close on Monday, I am expecting once again for this market to potentially rotate down to around 16,100. Now, to put this in context of the bigger picture, although this is a short-term sell signal, I'm not expecting this to take out these lows. Before we take out these lows, we need to see this market rotate all the way back up to at least the 100 and the 200 simple moving averages. And most importantly, get that macro retest of this old support level as new resistance. So, I mean, although, again, in summary, this is a very strong bearish reversal indication, and it's showing up right at that declining 50 exponential moving average. You can see that right there. I'm still short-term or intermediate-term bullish all the way back up into this box up here, or just around that 17,100 area. Now, on top of this signal, again, if we go back to Friday's candlestick, I'll just zoom in on the detail. I've had a few people email in and say, look, is that a shooting star? And I mean, it's a hybrid version of a shooting star. It isn't a textbook shooting star. Generally, what we want to look for is an upper wick at least 2 to 3 times the real body candlestick. And if you have a look at this candle right here, that just isn't the case. It's more so a 1-to-1. So the real body is more or less the same size as that upper wick. It takes the same formation to a degree, but you're really stretching the analysis. All you can really do as a technician is just say, look, I mean, we're at a resistance level, a very important resistance level, and we're seeing sellers with these upper wicks. And again, today on Monday, we've seen the same formation, not so much the shooting star, but just the actual upper wick on the daily candle. Once again, inform us that people are selling this market up at this level, just shy of 16,750. Again, I'm not expecting this market to do anything like this over the coming weeks. I'm still expecting the wave rotation higher, and this is going to be a slow and gradual type of grind, in my opinion, which is going to flake out just around this 17.1, potentially all the way up at 17.5. We'll just monitor it as the market continues, but these are still the projections and estimates which I'm looking at as a technician. Now, to take this one step further, I spoke about this over the weekend. I'm going to keep this next section brief, but what I say following this next section is going to be very important. So if you hang around towards the end of this video, we've seen a major sell signal take place on the monthly chart. But what I'll do for you very quickly is just bring up the momentum oscillating indicators right here. And you can see on the daily, the Stokes is starting to give us a cross. Now, I spoke about this over the weekend. The RSI is starting to reset, but the MACD itself is still bullish. Generally, when you see the MACD cross and it shifts momentum, that is when you see a rollover take place. And what we're seeing on different time frames is that they're not in agreement. This is the daily look at the Dow Jones Industrial Average. This is the daily oscillators of the Dow Jones Industrial Average. Take a picture, take a snapshot in your mind or in your brain just for a moment there. And you can see, obviously, again, the Stokes is starting to cross. We are overbought. The RSI is resetting, but the MACD is still bullish. Now, a lot of people are looking at this signal and calling it, some form of a channel going on right here. A channel is another word for consolidation. What it means is that the market is consolidating sideways between almost a perfect sort of demand and supply, at resistance and also support. We get up into these overbought areas, and then the next natural oscillation is back down to support, where, of course, demand will pick back up, and then we'll see again the next ebb and flow of the market back up to 16.5. Well, that's all well and good, but when you pay attention and you go up another level in terms of the weekly, we're just starting to see the buy signal take place in the weekly stochastics, and I spoke about this over the weekend. So we're seeing time frames which are simply not in agreement. Now, I'm not going to do this for you, but if you go back to both 2000 and 2008 and you have a look and you can put this together, or at least piece this together very easily, because I've said very openly where I believe we are in context to both of those bear market transitions. What generally happens is that the market itself doesn't roll, and you do not see that lower continuation on high volume and strong momentum until this stochastics oscillator on the weekly time frame sort of adjusts itself up into a higher level, closer to that overbought reading, which will align with the daily. And then when you see the roll on the MACD, that is when the markets usually pitter, or when they really start to turn. And again, that flows perfectly in alignment with what I'm looking at 17,154. So just make sure that you understand timeframes and different signals on different time frames, and how the larger signal really overrides the lower signal. So the bigger the time frame, the bigger the signal. And having said that, the weekly is starting to give us a bullish cross, which is showing that, look, momentum's moving to the upside, and that's what we've seen. I know this week we started off somewhat, bearishly. Dow Jones down 123 points. But I mean, this is going to be a slow and ugly grind higher, and I've said that the entire time. Even, of course, when we were going through this little bottoming pattern, and I called that the slope of hope rally, throughout September and October 2015. What we'll do is eventually we'll build structure, and then we can gauge that with option plays and, of course, inverse ETFs. But, having said that, I'm nibbling on shorts, and I started to open up short positions right on this particular candlestick Thursday last week. People privy to pro understand that I was shorting at the 50 exponential moving average, and I've highlighted a few other areas where I'm going to add to my shorts, just because I have enough conviction to say that, look, this bear market looks to be establishing itself based off those lower highs, the lower lows, and all of the divergent signals we're seeing both on the weekly and the monthly, and of course the transitory terminal reversal patterns, which are also setting up. This is priced in for a reason. The market isn't acting like this for no reason whatsoever. There is an underlying cause behind it, and of course on top of that, we've broken some absolutely extreme bullish trend lines, which have been in effect since the year 2009. This doesn't happen randomly. There is a reason why this is taking place. Sometimes it's larger than us at this moment, and the catalyst for this rollover may not, of course, rear its head for a number of months right now. But if I had to assume what it will be, especially in the financial sector, we're either looking at the Italian banking sector, the shadow banking industry, in China, or even Deutsche Bank, which is under a lot of financial stress. If I just bring up Deutsche Bank right now, have a look at the share price of Deutsche Bank, the biggest bank in Europe, especially Germany, obviously. But if we take a look at this chart right here, if I change to the line chart and bring up the weekly chart, this was the lows of Deutsche Bank throughout the 2008 crisis. We're actually below those lows, and we're sitting at a 25-year low on this stock. You have to ask yourself the question, why is this happening? And not only Deutsche Bank, but why are a lot of other financial institutions sitting at more or less 52-week lows at the moment? I mean, there has to be an underlying reason behind this. Now, again, you can get really technical. You can go into the fundamentals behind it. And again, you'll really come across varying, fundamental reasons for that. Some are saying everything's okay. Others are quite pessimistic. But, I mean, as a technical trader, we just read the charts, and it gives us a lot of shorting opportunities in the market when it rolls, or in individual stocks and ETFs. But of only when the technical picture allows us to do that. And as I take a look at the actual ETFs or the actual indices right now, I'm very close to upping my shorts at this point in time. But unfortunately, I can see something like this happening, a pullback, and then that grind continuing higher as that weekly stochastics oscillator moves back up. and we get, the final retest of this macro resistance level, which was once support again in November and December, the back test, which often happens technically speaking. Now, taking this one step further again, today obviously being the last trading session of February, it doesn't matter which market I apply it to, but what I'll do, I'll bring up the S&P 500 again, more or less a mirror image of the Dow Jones Industrial Average. We've seen this, almost double bottom, which a lot of people are calling a double bottom. Unfortunately, it's not correct, because we're not at, the right location for this, given that we haven't really seen the establishment or a major continuation in terms of the bear market yet. But what I'll do for you is just quickly change to the long-term 100 and 200 simple moving averages. And to make this really clear, I'll take the annotations off the screen and I'll recalibrate these just to a lower time frame. And the reason why I'm using the 100 and 200 simple moving averages is because I need to show you this with a simple moving average. So I'm going to change the first line to 10 and the second line to 20. And this is just using, again, a 10 and 20 month simple moving average. This is the final print for the month of February. So what I'm going to do, first of all, is zoom in and show you this. We've seen, again, the market stagnate since the end of 2014, definitely 2015. We really established that upper resistance level. And since then, again, we've seen the first lower low, which is a major lower low on the monthly chart. We've seen the snapback rally up to very close to resistance areas. We've seen the secondary lower high. And again, we've just put in another lower low. All right, this is big in technical terms, especially according to Dow theory, seeing these different indices confirm. But what's even more problematic for the bullish case right now, especially given this signal, is that you've seen the 10, which is in pink, cross below the secondary line here, which is the 20 simple moving average. Now, again, for someone who isn't a technician and a fundamentalist, I mean, that's fine. You can more or less dispel or not agree with what I'm saying, and I get that. But when you go back in history, and you apply this to the financial markets, very rarely do you see these crosses take place, and especially the crosses take place once the lower low and the lower high has been established. If you go back to the last time we got a cross, you can see for yourself, we haven't actually got a bearish cross since 2008. And when we got that cross, markets rallied back up into the 10 and the 20 monthly simple moving average, and then that was lights out for the market. You see that retest right here. This aligns very much so, more or less perfectly with my analysis, which I've been sort of performing on these markets up until, of course, this new piece of analysis has just developed right now. So, I mean, if history repeats itself, and technical analysis really is just the study of emotion and sentiments of technical traders or market participants transacting in the marketplace, patterns repeat themselves, and that is why we can apply technical analysis to the financial markets. So what we've just seen again is a sell signal which hasn't generated since the year 2008. It is a very rare sell signal. That sell signal has formally signaled as at the close of trading Monday. All right, it's done. That is the final print for this monthly monthly candlestick here. And just looking at the candlestick itself, it is a doji. It's not, it's not offering us too much insight. It's just showing us a little bit of confusion in terms of momentum and, of course, direction. And I mean, you can't really take all that much away from this particular monthly candlestick. I can make a very easy bullish argument. I can also make a very easy bearish argument. This is really a 50-50 signal. And we need more data, especially on sort of lower time frames, definitely the weekly and, of course, the daily, which is what we use as technical swing traders, until we start seeing confirmation of a break below these levels or seeing these markets rise and opening up shorts, where I'm looking at on the S&P 500 around that 2000 level all the way up to about 2020, 2030. I mean, chances are we can even go up to 2070. I'm not completely writing that off. But what I'm trying to say to you right now is that the weight of the evidence, and again, I'm just a technician, I'm just a chartist, I'm bringing this information to you because it's very pertinent, and I want to share this with you because, I mean, if you take the lessons of the past and apply them to the present, I mean, you can really make some big, or at least create big opportunity from what may be, again, a very bearish 2016, and that isn't 100% confirmed yet, but given the weight of the evidence and how things are continuing to shift more so bearish than bullish right now, you need to be updated on these signals. So this is a very big signal which is generated. Since we got that signal, we saw about a 2-month rally going back to 2008 until we got the retest. And then we got the capitulation, we got the breakdown below the established support. And again, I'm trying to show you that right here. The established support is coming up just above 1,780. And if that happens, that's when movements like this happen. All right, they're very easy to predict, but it's just it's the slow process until we get to that tipping point where everything is aligned for that major move to happen. All right, and I'm sitting here as an analyst saying that I can see the writing on the wall, but we just need a few more things to take place until, of course, we expect the big one to start. Now, I'm always, I guess, evaluating and rechecking what I'm saying. And sometimes I sit down throughout the day and just try and go through all of the bullish arguments which can possibly be made as a technician on this market. And again, it is very one-sided from that or shifts from the bullish argument to the bearish breakdown. And that last signal there, the 10 monthly crossing below the 20, is a major sell signal. I can go through and do similar types of, I guess, routines with the weekly. Exponential moving averages, again, when you see the 20 cross the 50, that is a major sell signal again. However, sometimes it produces whipsaws. But you don't trade technical markets just simply off exponential or even simple moving averages. You want to see price confirm above or below certain levels. And we're seeing the extremes. You're seeing it yourself. This isn't a secret. It is in front of us. It is hidden in front of us. And people who want to argue against reality, unfortunately, they're the ones who are going to be burned if, in fact, this really plays out, which I can see happening in a couple of months' time. So, I just wanted to update you on that as at the close on Monday, and I'll leave it at that. Lastly, I just wanted to say I'm not I'm not here to upset or disappoint anyone. I respect your opinions, but at the same time, please, know what you're talking about before you send through foolish comments, okay? And that's all I wanted to say. If you don't like the analysis or if you don't agree with it, you don't have to come back and listen to it, right? But, having said that, I appreciate your comments as long as they're not condescending or rude in nature, all right? As long as they're constructive and you put up a valid point, against what I'm saying, well, I'd be happy to read it and think about it. But the weight of the evidence, again, suggests that these markets are going to put in lower lows. And I'm just sharing that information with people who want to listen to it and just to really see the writing on the wall as to where these markets are moving, okay? And the direction is clearly down. We are in an established primary downtrend. It's there. And we're just looking for this reset or this correction, this bull market bounce to conclude until you see the waterfall sell-offs, which are going to last longer than 1 month as we break technical macro support. And once this level is broken, you don't want to be holding long trades because you will get wiped out very, very quickly. All right. So on that note, friends and traders all around the world, it's James signing off on behalf of Pivot Point Trading. Have a fantastic evening and also a fantastic week. I'm not really doing all too much in terms of individual trades right now. I'm following these markets. I'm seeing the technical picture develop. Again, a very strong sell signal. It wouldn't surprise me to see this market pull back. But ultimately, I'm looking at this market making a bounce, putting in somewhat of a short-term higher high, but ultimately a long-term lower high compared to where we've been in May, in June, and July. And of course, the retest in October, November, December. And that's where I'm looking at this market going. So if you have any problems with that, or if you want to put up counter analysis, please do. Just make it, just don't make it mean-spirited. That's all I request, okay? So on that note, everyone have a fantastic week. I'll be back with you later in the week if, in fact, we see some major continuations to the downside. If we see other major sell signals or even bullish buy signals, if they show up, I'll be the first to report on them to you. But unfortunately, the 10 isn't crossing the 20 in a bullish alignment. We're getting these major sell signals develop, signals that we haven't seen since 2008 as at the close on Monday, and saying goodbye to the first or the second trading month in the year 2016. So all the best, everyone. It is James signing off on behalf of Pivot Point Trading. Goodbye.